Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Good afternoon and welcome to our roundtable discussion on what it takes to be a successful ESG story in emerging markets. Now, according to our calculations, around 6% of emerging market assets are already run under some kind of ESG mandate, and that share has more than doubled since the end of 2019. But we think that actually misses the point somewhat, because what we're seeing now is that more and more non-ESG dedicated investors are gradually adopting ESG policies into their investment processes. Now, ESG is very often dominated by the climate debate, emissions, and the carbon transition, and this tends to get very technical very quickly. So if you want to learn more about that, I could suggest that you watch the previous panel, which is available on our YouTube channel, which goes into that in a lot of detail. In this session, we wanted to escape a little bit from the carbon debate and showcase some of the more successful ESG stories outside of the energy and commodity space. So I'm delighted to be joined today by Ingrid Kukuljan, the head of impact investing at Federated Hermes International, a firm with $620 billion of assets under management and one of the industry pioneers in responsible investing. Manjit Dhillon, the CFO of Helios Towers, one of Africa's leading towers businesses, and Neri Tollardo, the Director of Strategy, Vice President of Tinkoff, Russia's most successful and innovative financial services or fintech company, I should say. Now, Ingrid, I'd like to start with you. Companies tell us that more and more of their investors are coming to them asking questions about ESG, but many of the corporates at the same time are quite confused by all the different approaches that investors have. Maybe you could set the scene by running through some of the main types of ESG investing for us.
Sure. Hi, Daniel. Thanks for having me, and a great question to kick off. So yes, there is still a lot of confusion in the market. We actually refer to it as responsible investing. And the main difference between ESG, sustainable, and impact investing is that a sustainable company seeks to do no harm by practically taking into account all of the material ESG factors in order to maximize long-term value. Impact investing goes one step beyond in that it purposely targets companies that have quantifiable outcomes and positive impact, whether it's social or environmental, in addition to financial gains. So whereas an impact company can be a sustainable company as well, vice versa is not the case, because you need to quantify the impact and what it means in terms of investment. With ESGs, it's very easy to run a kind of exclusionary based quant product, but if you're a sustainable or impact investor, it's definitely the domain of the active funds, given how many different factors you need to take into account.
Okay, so moving over to Manjit. At Helios Towers, you're operating across a very wide range of African geographies. Now, I know that ESG has been quite an important part of your strategy since actually long before your IPO. What is your approach here? Is it something that you're doing to attract more investors and bring down your cost of capital? Or is it something kind of core to your business that helps you anchor your values as a company when you're setting out your strategy?
Thanks, Daniel. Yes, absolutely. So just a bit of a background into terms of who we are. So Helios Towers is an independent tower company operating across multiple jurisdictions in Africa. And effectively what we do is we build or buy towers to which mobile network operators put on their antenna so that we can provide 2G, 3G, 4G, and hopefully one day 5G signal to a wide variety of people and populations. So our business innately has quite a developmental focus because we're effectively building out the infrastructure to which people can get mobile telephony. And as we know, mobile actually hits all the UN Sustainable Development Goals. So to some extent, we innately have a developmental factor to our business and a strong ESG leaning. However, ESG is more than just having your innate business. It actually is about what else you can do. And as a company that operates in some challenging markets, we have a big impetus on good governance. We make sure that we've got the processes and systems in place to ensure that we can operate as effectively as possible. We also have a very strong social leaning. We've always wanted to ensure that the staff that we utilize very closely correlates to the communities that they serve. And so we have a 100% African employee base in the operating markets, which we think is very, very important and something which we will continue to do going forward. And then there's the E part, which is the environmental, which has always been a big focus of ours. The actual innate business model, again, of a tower company actually reduces the need for duplicate infrastructure, thereby reducing the need for duplicate generators, producing duplicate carbon, and all of the other benefits that has. But again, there's other things that we can do to try and improve our overall power generation so that we're able to provide good, reliable telecoms to the end consumer. And this has always been part of our business. This has always been what we focused on. And that's principally been driven by the fact that some of our first investors were development finance institutions like the IFC. We've also had Albright Capital as part of our overall mix and some other big private equity firms who have actually all had a strong leaning on this. So from day one, this has always been ingrained within us. What we've done since we've been listed, which was in the back end of 2019, was have to rethink how we communicate that. Because effectively, when you run a private company, a lot of this can just be discussed between the few shareholders that you have. When you become public, it becomes a far differing ballgame, and you have to effectively make sure that your comms around it is well understood, but also understand the different ways that people are looking at ESG and make sure that you've got a good and robust comms out there to ensure that your own vision is being aligned to what other people are expecting.
Okay, so I mean, along those lines, how do you go about prioritizing the different types of ESG in your work? Are you trying to look at the UN Sustainable Development Goals and seeing where you can align better with them, or are you looking at the things that which have the biggest impact on, or that you can have as a company, or how do you prioritize?
I think first and foremost, we are there to try and expand the development of mobile. That is the underlying fundamental of this business, and the way in which we do that is by building more sites or adding more people onto our towers. So that is what really drives the business on a fundamental level. Mm-hmm. And then we look below that, which is actually then about, well, how do we reduce our environmental impact? Can we use things like solar, hybrid? And actually, with our business model, if we're able to reduce the amount of carbon, reduce the amount of fuel that we're using, it actually helps us both on an EBITDA perspective, but also makes us more sustainable as well. So that then also feeds in. And then it comes down to, after that, how else can we look at alternatives such that we align to what investors and what we feel is important in the overall value chain.
Okay, and your most recent development there, I guess, is publishing your sustainable business report in March last month. How did that go? Was that quite a challenge? Was it easy to do? Was it difficult to bring everything together on in a single report? How was it?
Yeah, it was a very interesting process. I would say that in some facets it is challenging because the moment you put something into print, the moment you put something out to the investor community and to the community more broadly, because it's not just investors, it's all stakeholders who will be interested in this report and our reports more generally. You have to ensure that there is enough certainty and assurance in the numbers that you're putting out. And whilst on a financial perspective, that's exactly what we do with our audited numbers. When you're looking at ESG-based statistics, you don't often have that. So you have to make sure that you are very, very secure in your reporting that you're putting out. And I think that took a fair bit of time, just to make sure that we felt fully comfortable with what we were putting out into the market. I think it also came down to really taking time to understand all of the different stakeholders that we have in the business. Again, not just investors, employees, communities, and other people, what they thought of as being material for this business, and making sure that we were addressing all of those, because investors only have one part of this, it's everyone else as well. And that takes time. So I think together, it took a fair bit of time and effort to make sure that what we put out was well thought through, but also that what we were saying actually hit the key material areas. And I think in the end, we got to a pretty good point on it. There's still work to be done. One of the key things that we have to work on is our carbon targets, which we'll be doing at the back end of the year, which we can talk about later. But there's always more to be done in this space. And I think for us, what it took a fair bit of time to really appreciate was the materiality point. What is material for this business? What is within our controllables, and focus on that.
Thank you. Now, Ingrid, as an investor, how important do you find these sustainability reports? And what about standardization? When I read a set of financial statements, I know exactly how to navigate them, what I want to get out of it, and how to process the data. When I start reading sustainability reports, I get bogged down. They're all different. There's so many ESG parameters. Which ones do I look at? They're all evolving quite fast. So, year on year, the parameters are all changing. I mean, do companies need to report everything? How should they approach this? I think you're on mute, Ingrid.
To answer the first question, as Manjit said, it's very time consuming. And as such, for us as investors, these reports are very important for a couple of reasons. First of all, it shows that the company has a commitment to sustainability. There is data that you need to actually produce this report. So it means it's part of their strategy, and it gives us an insight in materiality factors that otherwise you're not going to see through P&L or your standard formatting. In terms of standardization, we are far off from standardization, and it's difficult because you're dealing with a number of different sectors. There are some metrics that can be applied to majority of the companies, especially on the S side, so the human resource management, on the G side in terms of governance, in terms of executive remuneration, and on the E side, everybody obviously talks about climate change. It's very important, but not necessarily applicable to everyone. So in the case of Tinkoff, S is much more important than E, which will be obviously more relevant to a metals and mining company. What should companies focus on? It's a great question. And for me, the answer is very simple. They should focus on what's important to them and where they think that they are creating value in terms of the ESG factors. So you need to be sensible about it. There is no point in trying to tick off all of the boxes, because not all of the boxes may be relevant to all of the companies. So you have to show the commitment to what is relevant to your business.
Thank you. And how about the ESG rating agencies? I mean, famously, their ratings are all over the place. When you look at credit ratings, they're all quite aligned. The ESG ratings are not aligned in any way. I mean, are they useful or not? Should companies try to target a certain sustainability score from the rating providers? Or what are the pros and cons here?
I think it's very difficult to try and actually target a certain rating. As I just said, companies should focus on what's important to them, because one issue with the ratings agencies is obviously that they are backward looking, we as investors are forward-looking, and businesses are also forward-looking in terms of their strategies. So the ratings agency are not going to capture stories that are in transition, that are moving towards being sustainable, towards being impactful businesses, and the ratings will not reflect that. So I think businesses should just stick to what's important to them, and the ratings, will follow.
Okay.
I'd like to pitch in on that one because I do agree with you, Daniel, to some extent, and I also agree with you, Ingrid. But from our perspective, when we do speak to a variety of investors, getting a rating is actually a key component part for them being able to invest, particularly for ESG and impact funds. And I think that, to the point on the credit rating piece and where you can get some kind of standardization and an understanding of what's being put out, I think that with the amount of money that is now going into these ESG impact funds, there needs to be some kind of similar movement in the rating agencies, because it is something that is a key consideration for some investors. And certainly that has an impact in terms of the ability to which investors can then invest. To give an example, we are currently being asked to get a Sustainalytics rating, and that's proving a little bit challenging on a timing perspective. And I think that's principally because there's so many companies who are looking for this, and resource constraints, also working in the light of COVID as well, being at home. There are a few things here which are kind of coming together. So I hope that the broader rating environment does actually start to improve as well, and get the resource that it needs, so it can actually facilitate all of this demand and all the looking that's happening at the moment on the investor community side.
I think that is happening because, the comment that you just made has been made by a number of other corporates, and it's especially strenuous on, small and mid-cap level, where they just don't have the resources to comply with all of the ratings and, fill in a myriad of forms that are sent. So.
And from my side, it's clearly becoming an issue because more and more funds themselves are becoming rated on ESG. And what's happening is that various providers are taking a kind of weighted average of the ESG ratings from the rating agencies of the stocks in their portfolio. So even if those ratings are not very useful for Ingrid, they end up rating the funds themselves, maybe erroneously, but it's a fact of life at the moment. So some kind of standardization or visibility on that front would be very helpful. Okay, moving on to Neri. At Tinkoff, you published your first sustainability report almost a year ago now. Tell us a bit about what prompted that. Was it for an internal audience, for an external audience, for investors, for regulators, or to tell a story about how the firm is evolving? What was it for you?
Yeah, thanks, Daniel, and thanks again for having me on the panel. So technically, it was actually our second non-financial report, but it was the first one where we really started to gather feedback from the various stakeholders. Clearly, it started to be triggered by investors who, for the most part, and as an increasing amount, have to have some kind of ESG lens through which they look at their portfolio. But then we try to already gather contributions from analyzing the priorities of our employees, of our customers, of our partners, and also of rating agencies, because although they are very different in the way they rank your business, they can give you a little bit of a nudge as to which direction you should look if you're at the starting point of your ESG journey. To us, what became clear is that we were doing already a fair bit of ESG related activities in the company, especially on the S front, because we're a financial services provider. So as Ingrid said earlier, E might not necessarily be at the top of the priorities, but on the S front, we were already doing a lot. But what we were lacking on, we were not communicating those initiatives well enough. And secondly, perhaps we needed a more strategic approach to sustainability. So this report was effectively the first step to try and address those two issues. And we're at the beginning of the journey, but I think it was important to make sure that we had our commitment out there, and that investors knew that we were going to take this seriously and we were going to improve on the previous sustainability disclosures, and that we're going to continue to do so in the near future. The main audience for us at the moment is clearly the investor base. Again, more and more of them are asking us to disclose more data on ESG and sustainability initiatives. But I think it's increasingly becoming a topic for other stakeholders. And we're noticing that because our employees, for example, are quite young. The average age of our employees is 26, 27 years old. They're quite socially conscious, and they want to know that they're working for a company that is doing good in the world. The central bank very recently has also started consulting with various players in the market to understand how ESG risks are embedded in strategies and embedded in risk management. So it was very important for us to start this process as early as we could, so that we have good momentum from the start, and we can make sure that we address all the needs and requirements of all our various stakeholders. We think we're in a relatively privileged position, again, that we have a strong corporate and social corporate culture. When it comes to our products and our services, we're very customer centric. We're very investor friendly. We're a progressive employer. So we think we have all the right ingredients to become a successful ESG story, but it's all to play for, and we're looking forward to continuously improving on our disclosures and practices.
Thanks, Neri. Back perhaps to Ingrid. I mean, do you have some general advice, Ingrid, on what companies should really be focusing their efforts on when it comes to ESG? I know you think it should be company by company, but in general, where should they be looking at?
Let's start with E, because it's the most popular, obviously. Climate change is the obvious one. What is your strategy around climate change? What kind of actions are you taking? Pollution, waste management, water management. Water management is really important. We'll look at that a lot given the scarcity. In terms of the S, obviously you have, the human capital management, the inclusion, the diversity part, but also what companies should focus on is their supply chain. What's going on in their supply chain. That is something that is quite big for us and that we put a lot of focus on, and, how their supply chain is being managed, especially in terms of the labor rights as well. There is also the part to think about, in terms of the governance, the executive remuneration, the board effectiveness, but also the terms of employment for employees. Today we are operating in an economy where it's not anymore just, the full-time, the part-time. There's the contractor, there is, the freelancer, etc. What is your treatment of those type of employees as well? So it's, the benefit of all stakeholders, not just, a few chosen ones. And lastly, in terms of strategy and the risk to the business itself, what are you doing in terms of data protection, in terms of cybersecurity? Are you actually taking care of your operational risks? Do you have strategy in place that deals effectively with, individual operational risk that are, again, different for every business? So those are some of the broad themes. But one thing that I would point out, and especially I think it's relevant to emerging markets, is the theme of biodiversity and the natural capital preservation. I personally believe that it's even more alarming than climate action, and we're looking to see how companies are preventing the loss of biodiversity, because it's so important to the economies and to the communities.
Okay. Now, as a global fund manager, you can invest in emerging and even frontier countries and companies. How do you have to adapt your framework when you're looking at some of the emerging or frontier markets? I'm sure Manjit would agree, for many of the frontier countries, if people don't invest in them, they will never improve. So it's very important to get money flowing into these countries. But often they're starting from a lower base when it comes to some of the raw ESG scores, but in some cases improving quite rapidly. How do you think ESG investors can adapt their frameworks for that?
Frankly speaking, in terms of adaptation, you're not going to see a lot of that, because, the metrics are those, and the ones that I just mentioned that are probably relevant to every business. And it's on the companies to actually improve their ESG practices and to come up with solutions internally, which obviously is not easy, especially in the frontier markets, given the size of the companies. You don't have, so many large companies with capex that they can spend on this sort of activity. So EM is lagging behind DM overall, but it's something that will need to be addressed. And we are seeing positive changes. We are engaging with a number of EM companies, and we are seeing that, they are on the right path in terms of the ESG it's going to take some time, but they're making huge progress.
Mm-hmm. Okay, Neri, back to Tinkoff. Has shedding an ESG light on your business made you change anything? Made you adapt parts of your business? Is it changing how the business is run in some ways, or is it making the discussions that you're having with some of the stakeholders, with the regulator, with investors a bit easier? What are you seeing there?
Yeah, look, I think it's definitely adding a new angle to our company strategy, and we are looking to formalize in the near future what aspects of our strategy will have a more sustainable angle and message. I wouldn't say it's making the conversations easier. If anything, it's actually making the conversations more interesting, because you end up tackling topics and issues that are quite important. It forces you to think even harder about longer term risks, and I think in many respects it actually creates a stronger relationship between the various stakeholders, because I feel like the input that you can get from investors and third parties on ESG practices and sustainable practices can often be significantly more relevant and sizable than other inputs in other parts of the business. And so we seek actively to have these conversations with our investors. And it's also helping us to decide which areas obviously have the most impact and where we should have our strategic focus. I think I agree with Ingrid that it's what's relevant to us as a company, but obviously having that input from investors and the other stakeholders also helps you to direct your efforts.
Okay, and you talked earlier about your ESG journey, which I think is probably the right word for it. And we've seen so far quite a few improvements on the corporate governance side, collapsing your dual share structure, revamping the board of directors. Where do you think things head next? Do you think it's about data security, responsible lending, looking at the partners on your super app? What are the kind of directions that you see it moving into over the next few years?
So, as you rightly pointed out, governance for us was one where we started with a lot of effort throughout 2020. I think we were one of the few tech companies worldwide who actually collapsed their double share class so that the founders did not have any super votes anymore, and all the investors now are on the same exact footing. That's being followed by a revamp of the board of directors, where we're looking to increase the number from 5 to 9 directors, with a majority of independents, and increasing the share of female and underrepresented groups in the board. We'd like that board to also have a level of accountability over sustainability practices. So we're looking to add a sustainability or risk, emerging risks committee. And this is all work in progress. And hopefully we'll have more news to give to investors and to the broader community over the next few months. As for the other topics, you mentioned a few right ones. So clearly for us, financial education and responsible lending are at the core of what we do. Especially as we are now the third largest bank in Russia and we have the leading retail brokerage platform, it's incredibly important for us to make sure that our customers know what they're doing and to help them out with their finances, especially as they're starting to, many of them are starting to invest and save for the first time. So we're spending a lot of time and effort on making sure that we can educate our customers. As we're a digital player and all our platforms are digital, data security and cybersecurity are also of paramount importance. And we have to make sure that we know what we're doing. And we're very jealous and mindful of our customers' data. So it's about putting the right checks and balances to make sure that, again, we're holding that data very tightly. And as far as I'm aware, we don't resell or provide to third parties that data. We keep it to ourselves and we keep it in very safe hands for our customers. But also we're starting to learn that actually there are areas where maybe we haven't had the focus where we want as much as we had expected. And so, for example, we did recently a survey of our customer base, and quite surprisingly, we noticed that the environmental agenda was quite important for them. And it's not necessarily something that would have flagged as crucial for us because, again, we're a digital bank. We don't have any branches. We don't lend to any large metals and mining or oil and gas companies. So for us, environmental was always something that was slightly secondary. But it actually turns out that our customers want us to do more on that front. And so now we're launching a project where we're going to be assessing our carbon footprint, our emissions, and hopefully we can be one of the companies that actually come out with quite ambitious targets as to what to do with our carbon footprint. So it's evolving all the time. And we're learning more as well. The more people we talk to, the more we learn what's important for them, and we're trying to all formalize it into one strategy with certain priorities. Look, it's quite exciting, and it's causing a lot of interesting internal discussions, I would say.
Good. Now, Manjit, how have you found that you've had to either adapt or maybe explain your ESG approach, given the focus you have on frontier markets in Africa? Are there some things that you've had to explain to investors that are perhaps unusual or that they weren't expecting? I think you were alluding to perhaps the carbon emissions story earlier, that for Africa to develop, it will end up emitting more carbon by its very nature, perhaps before the carbon emissions go back down again. What kind of things do you have to explain which maybe are different for investors?
Yeah, I mean, look, we are coming from a lower base in the markets in which we operate, and I think that is part of the story that we have to tell. I mean, ultimately, as a business, if we want to expand and we want to try and develop mobile telephony cover, unfortunately, you don't have the grid availability to match that, either in terms of where it reaches or in terms of its reliability. So you have to use alternatives, and the point of mobile in particular is that when you are trying to provide mobile signal, you need to be able to provide it 24 hours a day. And that's not always possible with things like solar, wind, hybrid, etc. So you have to use diesel generators. And ultimately, there is at the moment a bit of a trade-off between the ability to provide more mobile, to develop the nations and use mobile as a leveler, because it is one of the greatest levelers when it comes down to development. It gives the ability for people to be engaged and to be able to link to the world. But that also comes at the short-term impact of actually having a bit more diesel utilization. And there's been a lot of research on this, and Bill Gates has even said actually that in terms of Africa, it produces 2% of the world's carbon. And you do more detriment by actually not investing in that market and not letting it develop than you would do by implementing the same structures that you have in more Western markets. I think that's a very important point to kind of bear in mind. It's certainly something which I'm talking to broader ESG and investors about, because utilizing the same matrix that you've got for other countries and other companies may not always be the best thing for the markets in which we operate. And I think a more differentiated approach is actually also useful for both how we put forward the story, but also how it's received as well. But yeah, carbon is certainly something which we're working on at the moment. We're doing a lot of work on it actually, and during the second half of the year, we'll actually put forward our carbon targets, which I'm really interested in and looking forward to kind of communicating more broadly. But ultimately, in underlying everything, we agree that we need to try and go to a net zero carbon target. It's just how do we get there, and how do we provide the level of mobile telephony that Africa deserves? Because bear in mind today, in sub-Saharan Africa, a quarter of the people still don't have mobile coverage. Only a quarter of the populations are actually using mobile, and 50% have coverage who don't even know about it. So there's a big divide, a big digital divide, and it's only going to exacerbate development. So it's important that we continue on that path.
And I think for Ingrid, this must be important for you, the whole idea of engagement and stewardship. How do you get that information from Manjit about what's going on, that maybe there may be an increase in carbon emissions before they come down again? So I think at Federated Hermes, you've been doing that for 20 odd years now. And I think last year engaged with 1,200 companies. I mean, how important is that for both you and for the corporates?
It's very important. So in addition to 620 billion of AUM, we have another 1.3 trillion of assets under stewardship, which is practically engagement. And we represent 50 of the largest pension funds in the world, alongside a number of other investors. So it's very important because we see it as a major tool in our drive to what we call sustainable capitalism. And what it gives you is, first of all, helping companies, focus on which are the important ESG factors, what they should be driving forward in their strategy, in their agendas. On the other hand, for us as PMs, it also helps us because we can, have a communication with the company, and we have communication on C-level, C-suite level, board level, where you can really, drive this change. And lastly, interesting what Neri was mentioning about, this is a good example about a financial company and that their clients are, asking about environment, etc. We are a shareholder in one of the largest microfinance lenders in the world. Wonderful, impactful, sustainable business. There was just one issue with it, and that they were lending to non-sustainable palm oil producers as well as to coal companies. So we engaged with them over a number of years, and through engagement, we actually managed to stop them from getting involved in such practices. So even though it was a financial institution, we still managed to drive a positive change there. So engagement is crucial, and it helps not only clients but companies as well in knowing, where they should be focusing.
All right. Thank you, Ingrid. So, to sum up, it sounds as though communication is a vital part of the ESG story. It's still rapidly developing. More and more investors are starting to adapt their frameworks to bring in ESG into the way they invest money. So it does seem that this is a growing part of the investment universe and something that we all need to keep track of and try and get ahead of the curve as much as possible, as I believe both the companies here, Tinkoff and Helios Towers, are, as well as you, Ingrid, as an investor. So unless there's anything else that anyone would like to talk about, I think we'll wrap it up here. And I'd like to thank you all very much indeed, Ingrid, Manjit and Neri, for your time. Thank you very much, and let's keep discussing. Bye-bye.
Thank you.
Thank you. Thanks, everyone.
Bye.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs, Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.